Let's imagine that two friends decided to start their own company. They had already spent their own savings, borrowed money from their friends, and everyone else they could borrow from. But this was not enough to develop their business. So the friends turned to the bank to take out a loan. After carefully studying their business plan and the assets they owned that could be used as collateral for the loan, the bank considered their business too risky and refused to grant them a loan. To avoid failure and not lose the money they had already invested, the friends decided to issue shares. In order for the company to issue its shares, it must first become public. The company must undergo a financial audit and prepare an issue prospectus, a document that describes who they are, how much they earn, what risks they face, how many shares they plan to issue, and at what price. The reports are submitted to the financial regulator, who checks that everything is fair, that there are no hidden debts or fraud. To simplify this process, friends turn to investment banks for help. An investment bank, or underwriter, specializes in preparing companies for an IPO, initial public offering. In simple terms, they help companies go public and issue their first shares. The underwriter conducts financial monitoring of the company, assesses the real value of the business and the possible price of the shares, and prepares all the necessary financial and legal documents. But the most important thing is that a large investment bank has connections with thousands of large investors, reputation, and experience in conducting hundreds of IPOs. The bank essentially guarantees that the shares will be bought up by investors. Even if demand turns out to be lower, the underwriter undertakes to buy up the remaining shares itself to prevent failure. Our friends chose a well-known bank underwriter and stated that they needed to raise $1 million to expand the company. To understand how many shares need to be issued, the company must first determine in its charter the total number of shares that will make up the company. It's like outlining the whole pie so that you can then cut off portions of it in percentages. Let's say our friends decided that the company would consist of 10 million shares. Now they need to set a realistic price to understand how many shares they need to sell to raise the necessary $1 million. The most interesting thing is that before the IPO, no one knows what price investors are willing to pay. If the company sets the price too high, no one will buy. If the price is too low, it will lose millions. You need someone who understands the market and can find the optimal price. This is the main job of an underwriter. How is the share price of our friends formed? For this purpose, roadshows are organized. The underwriter runs an investment tour for the company, meetings with potential investors, where our friends present their business, how much their business is valued at, how they make money, why they need investments, and why it is profitable to invest in their company. During the roadshow, investors submit bids, how many shares they are willing to buy, and at what price, something like a demand auction. The underwriter compiles a book of bids, and after the roadshow, analyzes how many bids were received, from whom, and at what price. The table shows that at $50 per share, demand is stable, which means that this will be a fair price. When everything is agreed upon, the IPO takes place. The bank underwriter buys all the shares that our friends have put up for sale and resells them to investors. As a rule, the bank buys shares at a price lower than the official IPO price. The difference in price between the purchase and sale is the underwriter's commission. Thus, the shares were placed on the primary market. Rees and Campbell went public. Our friends received money to develop their business, and investors receive shares. After that, Rees and Campbell shares will appear on the secondary market. Investors who bought them on the primary market can now sell them on stock exchanges to other investors and traders. After that, the shares live their own life independently of the company and can change hands an infinite number of times, as well as rise and fall in price. But what affects the price of share on the stock markets? Simply put, the price of a share is equal to what people are willing to pay for it today, based on expectations of how much it will be worth in the future. In other words, stocks rise not because a company is successful today, but because the market believes it will be even more successful tomorrow. This actually seems crazy. In essence, the entire securities market is based on expectations and beliefs, in other words, on human psychology. If more and more people stop believing in a particular company, this is communicated to other market participants, and the price of their shares, bonds, or other securities falls sharply. If, on the contrary, for some reason more and more investors begin to believe in the future growth of a particular stock, more and more people buy it, and the price rises. The reasons that influence belief can be both objective and individual. Professional investors analyze a company's financial results, take into account new debts or investments, changes in management, and even the private lives of corporate CEOs. Professionals look at macro factors such as central bank interest rates, inflation, economic growth, the situation on international markets, politics, and wars. News directly related to the company's activities and its markets, as well as forecasts for the future. Subjective factors often have just as much influence, especially in the short term. Any news, rumors, or scandals instantly affect stock prices. If a large fund or investor sells or buys a large number of shares, it causes a cascade effect. The herd effect kicks in. People tend to buy when everyone else is buying and sell when everyone is selling. This often leads to financial bubbles and stock market crashes.